You know all those so-called golden rules of trading you hear about? Well, what if I told you they might actually be what's holding you back? Today, we're going to dive into the mind of a verified market wizard, a guy named John Netto, and we're going to debunk 6 huge myths that really separate the amateurs from the pros. Let's jump right in. All right, so first things first, let's talk credentials, because this is pretty wild. For over a decade, John Netto pulled off a verified compounded annual return of 42%. I mean, think about that for a second. That's turning an initial 100 grand into more than $3.1 million. Okay, but here's the part that really matters, the kicker. He managed to get those incredible returns while sticking to a super strict maximum drawdown of less than 15%. So, no, this wasn't some reckless bet the farm gambling. This was a total masterclass in managing risk. So, how in the world did he do it? I mean, how is that kind of high-reward, super low-risk performance even possible? Well, the secret is basically taking all the conventional trading wisdom you've ever heard and flipping it completely on its head. And this quote from him just perfectly sums up his entire philosophy. For Netto, risk management, having really, really good breaks, that's the whole game. That's what gives you the confidence to slam on the accelerator when a real opportunity pops up. And that brings us to a really key idea he talks about, the market regime. Now, that might sound complicated, but it's not. Just think of it as the big story, the main theme that's driving the market at any given time. You know, like right now, the whole AI-driven productivity boom. Netto says that if you can understand the regime, that's the key to knowing when to take smart risks, not just bigger ones. Okay, so with that foundation laid, let's get into it. It's time to start busting some myths. We're about to take on some of the most common trading advice you've ever heard. First up, myth number 1. This is probably the one you hear the most. More risk equals more reward. The truth? Nah. More risk usually just equals more risk. Netto's whole game is about applying smarter risk. It's about being intelligent with your capital when that market regime we just talked about is blowing at your back. All right, myth number 2. The idea that money always finds its most efficient home, that markets are perfect. The reality is, a lot of the big institutional money managers are just playing defense. They're making cover-your-butt decisions to protect their jobs, not necessarily to find the absolute best investment. And you know what? That creates huge inefficiencies that smart, nimble traders can take advantage of. Okay, let's switch gears a little bit. We've talked about the market, now let's talk about the trader's mindset. Because these next few myths, they're all about your internal playbook. We hear this constantly, right? Emotions are your enemy. Trade like a robot. Well, Netto sees it differently. He argues that what we call intuition, that's just your brain subconsciously processing thousands and thousands of hours of screen time and experience. It's a data stream, and it's an incredibly powerful one that you shouldn't just ignore. And this quote is the perfect example of that in action. When he feels too comfortable, it actually makes him nervous. Think about that. He uses that gut feeling, that visceral feedback, as a data point. It's a signal warning him, hey, maybe you're missing something here. Or maybe this trade has gotten way too popular. And that leads us right into myth number 4, diversification. We're told it's the only free lunch, the one strategy you need. But the reality is a bit more complicated. Look, diversification is fantastic for preserving wealth, but it's not how you accelerate it. True, rapid growth comes from finding those rare, high-conviction ideas and then making big, but, and this is key, strictly risk-defined bets on them. Oh man, you hear this one all the time, right? People get nostalgic talking about the good old days of trading, that today's markets are too hard, there's no opportunity. According to Netto, that is a complete and total myth. In fact, he's convinced we're living in a golden age, a renaissance of trading opportunities. And why does he think that? Well, just look at the tools we have at our fingertips. We have the democratization of information. Everyone has access. We have incredibly powerful instruments like zero-DTE options. We have access to global markets like never before, and all sorts of sophisticated products. The opportunities are literally everywhere. Okay, this brings us to our final section, and honestly, this might be the most important one of all. It's all about how we keep score. Because if you're measuring the wrong thing, you're going to encourage the exact wrong kind of behavior. So the final myth, number 6, is that performance should just be judged on returns. Pay for profits, right? The problem is that way of thinking just incentivizes people to take wild, insane risks. The professional way, the real way, is to judge performance based on the return you get for each unit of risk you take. So to fix this, he actually created his own metric. It's called the Netto Number. Think of it like a 3D scorecard for traders. It doesn't just look at your return and your volatility. It measures all of that against the risk budget you set for yourself beforehand. In other words, how much you are allowed to lose. This example makes it super clear. Look at this. You got two traders, both start with 100 grand, both end with 140 grand. Same profit, right? But, and this is the whole point, Trader A did it with a strict $20,000 risk budget. Trader B, they basically had no budget. They were willing to risk the whole account. Trader A showed skill. Trader B just got lucky. And that's exactly why Trader A's Netto number is way, way higher. And that's really the magic of it. This number cuts right through the noise and strips out the luck factor. It separates the person who is a skilled risk manager from the person who's just a gambler on a hot streak. It measures the quality of your process, not just the randomness of the outcome. So we'll leave you with this final thought. Think about your own trading, your own investing. If your only metric for success is the final P&L number, what are you really incentivizing? Are you rewarding skill, or are you just rewarding blind risk-taking?